Welcome to today's Explainer. We're jumping right into a classic corporate paradox today. How does a company's surface-level numbers paint this picture of absolute, undeniable success? Yet a deeper dive reveals a harsh, highly critical verdict. Well, let's figure it out. If you love dissecting how companies actually operate and where the real value is hiding, you are definitely in the right place. Okay, so let's get right into the core mystery we're looking at. We've got a massive corporation generating billions, yet the source material delivers a super blunt verdict of quote-unquote poor performance. To be exact, for the year ended March 2026, Exide pulled in nearly 18,000 crore rupees in sales. That is a staggering amount of money flowing through the business, right? Yet, right there in our source document, analyzing those exact same figures, is the stinging phrase, very poor performance indeed. So how on earth do we reconcile massive revenue with a failing grade?
Section 1. The Business of Exide.
Now, before we get lost in the balance sheets, we really need to know what they actually make. Exide isn't just churning out standard car batteries. Their reach extends way deep in the critical infrastructure. On the consumer side, they're powering everything from two-wheelers and e-rickshaws to your home UPS systems and solar setups. But look at the institutional and infrastructure side. They're supplying major original equipment manufacturers, keeping telecom networks online, powering railways, and ensuring massive data centers stay active. Actually, get this, they even manufacture highly specialized batteries for submarines. It's a really surprising level of technical capability that proves they are a deeply entrenched industrial giant.
And it's not just a domestic operation either. They are a truly global player, exporting to over 60 nations around the world. This international business brings in nearly 8% of their standalone revenue. Plus, they're actively expanding, having onboarded dozens of new distributors and industrial accounts globally just in the last fiscal year alone. So, we're looking at an expanding, globally diversified, infrastructure-critical manufacturer.
Moving on to Section 2. Unpacking the headline numbers.
At first glance, the financial engine looks like it's purring beautifully. What's really interesting is this solid growth trajectory. We're looking at a 15% jump in quarterly net profit, hitting 217 crore rupees, riding on the back of 4,735 crore in quarterly sales. Operating margins actually ticked up a bit too, moving to 10.31%. Look, when you see a company growing its top-line sales by 9% in a quarter and its net profit by 15%, the initial reaction is obviously to celebrate. It shows they're selling more and, crucially, they're keeping more of what they sell.
But even more impressive is this 150% figure. This is their ratio of free cash flow from operations to operating profit, and it's massive. Let me break down why this is absolutely crucial. The company generated 2,413 crore rupees in cash flow from operations and 1,293 crore in free cash flow. This essentially means Exide is a total cash-generating machine. They aren't just making accounting profits on paper, they are bringing in a tremendous amount of hard liquid cash relative to their operational earnings.
And to reward investors for all that, the board approved a 200% dividend payout. That translates to 2 rupees per share, signaling just immense confidence in their cash reserves. When a board signs off on a dividend like this, they're basically shouting to the market, hey, we have more than enough cash to run our operations, fund our immediate needs, and still send a healthy chunk back to you, the shareholder.
And just to completely cement the credibility of these figures, there's the stamp of approval from statutory auditors BSR & Co. LLP, who confirmed an unmodified audit opinion for the year. That's auditor speak for saying there are absolutely zero red flags. The numbers are clean, they're verified, and they represent a true, fair view of the company's financial state.
Which leads us to Section 3, Inside the Balance Sheet.
So here is the crucial point. If sales are up, cash flow is booming, dividends are flowing, and the auditors are completely happy, where exactly is the problem? Why the negativity? Well, this brings us right back to that highly subjective yet super blunt assessment from our source material. The author isn't just looking at a single quarter of profit. No, they're looking at the overall efficiency of the capital being deployed. Because at the end of the day, it's not just about how much money you make, it's about how much money you use to make it.
And the paradox is laid entirely bare right here. While Exide sits on a mountain, literally 13,820 crore rupees in reserves, all on a tiny equity capital of just 85 crore, their return on equity is a sluggish 5.97%, and return on capital employed is just 8.54%. Let's pause here for a second because this is the heart of the entire explainer. Imagine having this massive factory packed to the absolute brim with resources, but the factory is only running at a fraction of its potential speed. Exide has amassed nearly 14,000 crore rupees in reserves, but generating an ROE of under 6%, that means they're barely outperforming a standard fixed deposit with all that retained wealth. They are highly capitalized, sure, but they are absolutely not highly efficient with that capital.
Section 4. The Performance Paradox.
To truly understand why this capital efficiency is getting critiqued so harshly, we need to look at the long-term trends over the years, not just these isolated, flashy quarters. Looking at the 3-year compound annual growth rate explains the critique perfectly. Over a 3-year horizon, top-line sales have only grown by a CAGR of 6%, and bottom-line net profits have barely moved at a 2% crawl. I mean, in the fast-paced world of manufacturing and infrastructure, a 2% profit growth over 3 years essentially means stagnation. When you factor in inflation, real bottom-line growth is practically non-existent. And that is why the source text calls it a poor performance. It's this massive friction between a super cash-rich balance sheet and an engine that's just barely accelerating.
And these sluggish, long-term returns, they directly impact a really wide array of investors. You've got the promoters, who hold a near 46% majority, sitting right alongside domestic and foreign institutional investors. Domestic institutional investors, or DIIs, hold over 19%, and foreign institutional investors hold over 10%. We're talking about mutual funds, pension funds, and massive-scale investors who strictly demand capital efficiency. So while the stock has managed to rise about 8% in a year, that underlying fundamental drag of single-digit return on equity is something these major shareholders are going to be acutely aware of.
So, that leaves us with this final thought. Is this battery manufacturing powerhouse simply gathering energy for a massive future leap? Or is it a stalled engine, struggling to turn its vast reserves into actual meaningful growth? Exide's got the products, the global reach, the cash flow, and a totally clean bill of health. But until it figures out how to deploy that massive 13,820 crore rupee war chest to generate double-digit returns, that label of poor performance regarding its capital efficiency might just stick. It is a fascinating paradox to watch. Thank you so much for joining me on this explainer, and I encourage you to always keep questioning what the numbers are really telling you.